Hello there, my name is Elliot Tawanda Woninyika. I'm a lecturer at Chartered Accountants Academy, and in this session we're going to be discussing relevant costing. So we're going to find out that the principles we're going to discuss under this topic are very fundamental to most of the topics we are going to cover in this block 2. So please do take time to pay attention to all the things that we are going to discuss as part of this lecture session. So this class is broken down into two parts, namely part 1 and part 2. So I implore you to make sure that you take time to watch both part 1 and part 2 for you to get the most out of this recorded lecture session. So what are our learning objectives? So on completion of this lecture, you need to be able to distinguish between relevant and irrelevant costs and revenue. And you're going to find that this is very fundamental when you do many of your decision-making processes which involve capital budgeting, when you are doing enterprise valuations of equity. You need to know what are the relevant costs and what are the irrelevant revenues, as well as explaining the qualitative factors as part of decision-making, as well as distinguishing between relevant and irrelevant costs for specific 5 decision-making problems that we are going to discuss in this lecture session. Then you're also going to explain why the book value of equipment is irrelevant when making equipment replacement decisions, as well as explaining the opportunity cost concept. Then we'll wrap it up by discussing misconceptions relating to relevant costs and revenues. So I encourage you that after having completed watching this lecture recording, come back to these learning objectives and tick off if you achieved these learning objectives. Okay, so let's get into it. So the question is, why are we even worried about relevant costing? So it's all centered around decision making. So I hope by now you have noticed that within our math topics, when you are looking at all these various principles etc., they are ultimately linked to a decision that we need to make, which means that in an exam situation, you are highly unlikely to get a question which is going to say, calculate the relevant cost of this thing, or calculate that, but it's going to link to a decision that needs to be made. And you need to be able to identify that for this decision, I need then to be able to apply relevant costing principles. So in decision making, we need to have, or management need to have relevant information to facilitate decision making. And normal decision making involves choosing between alternatives. So if there are no alternatives, I'm not worried about relevant costing. But if I have to choose between two alternatives, I then need to be able to compare those two alternatives. So it means only costs and revenues relevant to the alternatives should be considered. Classic example is, I'm comparing two alternatives. Should I produce in-house or should I buy or outsource? So my decision making, one of the key considerations is, what is the cost of producing in-house and what is the cost of producing or outsourcing? So the question is, in doing that analysis, what is the relevant cost? So which then brings us to what are relevant cost and revenue. So in principle, a relevant cost is a cost item that is affected by the decision to be made. So it means that if I take this course of action, I'm going to incur that particular cost. I'll use a classical example. Let's say you own a car, and there are some associated costs that are come through with owning a car. So such as you have to pay your Zenara license fees, you have to pay your insurance costs. Then you want to make, you are deciding between two alternatives. You know that at the moment fuel is very difficult to come by. So you're deciding whether you should drive to work or you should go by public transport. So in that decision-making process, the cost of buying a car is irrelevant. Why? Because you already have the car. Also, the cost of paying your Zenara license fees is irrelevant. Why? Because whether or not you drive to work, you are still going to be required to pay your license fees. But the cost of the fuel that you need to drive to work, it becomes the relevant cost. Why? Because if you go by public transport, we are not going to incur that fuel costs. So if revenues and costs are independent from the decision, then it means they are irrelevant. So from a relevant costing perspective, we are only worried about incremental or differential cash flow that needs to be considered. Then if we've got cash flow that are common under both alternatives, it means they are irrelevant to the decision-making process, because I want to compare two alternatives. If they've got the same cost implications, those cost items irrelevant. Okay, so just do a quick recap of some of the cost classification issues that you can encounter in relevant costing. So the first cost item is a committed cost. So here we are saying we have already entered into a binding contract. Let's say, as an example, a company with a lease agreement, a 2-year or 1-year lease agreement. So the rental costs for the next 12 months are fixed, which means it's a committed cost. And other than that, then means that cost for the next 12 months is irrelevant if I depend on the decision that I would want to make. Then another type of cost that can come through is a common cost. Like I said before, if both alternatives are going to incur the same cost, then that cost is irrelevant. Then you also have what we call opportunity cost. So normally, when I'm looking at two alternatives, what happens is I've got alternative A and I've got alternative B. If I take alternative B, what opportunities have I forgone, or what income have I forgone from if I take an opportunity A? And we are saying that income forgone becomes a cost to pursuing alternative B. The same also holds to say if I take alternative A, I'm going to forgo possible income that I was going to get from alternative B. So that is the opportunity cost. That is also a relevant cost in decision making. Then we put what we call unique costs. So each alternative will have its own costs that come through as a result of pursuing that particular alternative. So automatically or ordinarily, opportunity costs then become relevant costs. Then we also have sunk costs. So a sunk cost is, these are normally historical in nature. We have already incurred the cost, and ordinarily they do not affect your decision-making process because you have already incurred the cost, which means they are irrelevant. Then avoidable and unavoidable costs. An avoidable cost is saying if I don't take this course of action, I'm going to avoid the cost. If I take this, whether or not I take this course of action, I'm not going to avoid the cost. So ordinarily an avoidable cost becomes relevant for that particular decision, but in unavoidable, a classic example would be a committed cost, because whether or not I do something, I'm still going to incur the cost, therefore irrelevant. Then we got allocated costs. Generally, these are fixed in nature, whereby, let's say, a company is operating using divisional structures, and head office costs are allocated to each division. So it finds that normally for decision-making purposes, allocated costs are considered to be irrelevant. Then lastly, we've got period costs. These are costs that are incurred within a period, whether or not you take a particular course of action. So in summary, this is just a guide in the various types of costs that you can encounter as part of decision making. Your job now would be to analyze each and to profile each cost item. What type of cost is it? Is it going to be affected by the alternative that I'm going to be pursuing? So then there's the issue now on short-term decision making and long-term decision making. So the main thing around short-term and long-term, you'd find that at times the variability of a cost item depends on the time horizon that you are dealing with. So you find that for short-term decision making, you've got some costs that can be irrelevant. For example, labor costs in the short term can be irrelevant. Why? Because we may not be able maybe to lay off our labor force should we take a certain course of action. But in the long term, a company is now in a position to lay off labor force, which means the labor then becomes a relevant decision. So within our syllabus or within the various types of decisions, short-term decisions normally are around selling price decision making, or you want to take on a special order. Those are examples of short-term decision making, and relevant costing is very, very important. Then when you go to things such as capital budgeting, valuations, you're also still going to deal with revenues, and expenses. So in that long-term decision making, you need to be able to identify which costs are relevant to this capital budgeting decision, which revenues are relevant to this valuation decision. So again, those same principles around relevant costing comes into play. What cost is going to correlate or vary if I take this course of action? So I'm sure you're going to see all these concepts incorporated when you then do your capital budgeting, incorporated when you do your valuations. Okay, so now relevant cost. From the word cost, it means we've quantified the monetary amount associated with us taking a certain course of action. But in practice, we also have some non-financial indicators, which are factors which we cannot quantify in monetary terms, but it's a relevant fact. So for example, if we make a decision that we are no longer we want to stop or discontinue an operation, we can do the quantification, say what is the cost benefit analysis, but over and above those quantitative factors, we need to look at other qualitative factors. See, if we are going to discontinue operations, it may require us to retrench staff, which may result in declining employee morale. Or we are making a make or buy decision. It may be lucrative for us to say, instead of producing in-house, let's buy outside or let's outsource. But what are the qualitative factors? It may then mean we are not dependent on a supply. So that supply in future can increase prices. That supply in future can go bust, which can then have an adverse effect on our operations. So in some exam questions, you may be asked to say, you are asked to make a decision, and then you do a quantitative analysis. Then the required can then say, can you also consider other qualitative factors before we make our final decision? And these are the things that we then expect you to be talking about and considering in your decision-making process. So now let's look at examples of specific decision-making problems in which we apply relevant costing principles. And please note, for the purpose of this lecture, you are going to focus more on the short-term decision making. For the longer-term decision making, such as capital budgeting, we address the principles when you do your capital budgeting lecture. So starting off, special pricing decision. So this normally relates to a decision to set a price which is outside the main market. So someone has approached us, they require a special order. And in requiring that special order, they are also requesting for a special pricing concession. So the question is, which costs are relevant in making the pricing decision? But the question is, at the pricing that is being offered, are we going to be able to make money? So let's use an example to illustrate some of the things you need to consider. So with X Limited, which is a manufacturer of clothing items, and it produces sweaters. Production capacity is got 5,000 sweaters per month. And we are told that because of the liquidation of one of these customers, the company has excess capacity. So for the next month, production is expected to be 3,500 sweaters. So it means automatically they got 1.5 excess capacity, and they are selling at $40. Expected monthly cost and revenue for an activity level of 3.5 sweaters are as follows. Direct labor, 42K. Direct materials, 28K. Variable manufacturing overhead, 7,000. Fixed manufacturing overhead, 28K. Marketing and distribution cost, 10.5. And their total sales are anticipated to be 140,000 to get 24.5. Now the question is, X has been approached by a leisure company which want to buy 1.5 thousand sweaters for the next 3 months at a price of $20 per sweater. And the company would pay for its own transportation costs, and there will be no additional marketing and distribution costs. And then no subsequent sales to these customers are anticipated. The company would require its company logo inserted on the sweater, and X Limited has predicted that this costs $1 per sweater. So should Caledonia accept the offer? At first value, the leisure company is offering $20 per sweater. So we may be quick to say, it's below our normal selling price of $40. But hold on. We have got excess capacity of 1.5 per month. And these guys are proposing to buy 1,500 sweaters each month. So effectively we are going to be utilizing the excess capacity to satisfy this order. So now the question is, if we take on this order at this price, are we going to make a profit margin? So when we then go to our cost structure, we then need to be able to identify the relevant costs. So if you look at direct labor, is it a relevant cost? So the direct labor per hour then becomes, say, if you are going to produce that extra 1,500 sweaters, we are going to incur the direct labor. It's a relevant cost. Direct material, if we produce these 1,500 sweaters, we are going to incur additional material cost, therefore relevant. But what about some of the fixed costs? So you are going to find that the fixed costs, whether or not we take the order, we are still going to incur those fixed costs. So not relevant. Then the marketing and distribution costs. We are told that for this order, we're not going to incur these costs. So automatically, for the purpose of pricing this order, not relevant. However, for this order, we have this additional $1 per sweater that we are going to incur. Which means if we don't take this order, we would not have incurred this $1. Therefore, the $1 per sweater becomes a relevant cost. So the key thing here in identifying a relevant or not relevant cost is always linked to the decision that we want to make, as well as to the variability of our cost structures based on the alternative that we are evaluating. Then from a long-term pricing, you then find that some costs that are not relevant in the short term can then become irrelevant. Because for example, in the short term, I've got a option of reducing my capacity. So in the previous example with 1.5 excess capacity. So in the long term, I can reduce that capacity, which can then result in the reduction of my fixed costs. So it means when you then go to capital budgeting, which deals more with the long-term decision-making process, some costs which are not relevant for a short-term decision may be relevant for a longer-term decision. So always take cognizance of that. So next step, please make sure you do go to part 2 of this lecture recording, and where we pick up on the specific price decision making, where we apply relevant costing principles. Thank you for taking time to watch this video. See you in part 2.